The first question I want to ask you is, do you think the interest rate on your savings makes sense? So again, welcome back to my channel. My name is Elijah, and today we're tackling a key topic for anyone looking to grow their money, and that is the savings interest rate in Nigeria. I'm going to break down today how interest rate really works, and I will also share about 5 or 6 solutions to help you to protect your savings from inflation. For context, inflation rate is currently 32%, and you will want to know how to make your savings really work harder for you. So let's get started. So question is, what are savings interest rate? At first, what exactly do interest rates really mean? Simply put, it's just the percentage of return that your bank or any financial institutions at all pay you for keeping your money with them. So it is just the foregone alternative for not having access to your money for a specific period of time. And in Nigeria, that rate typically ranges from 5 to 10%, depending on the bank. But here's the thing, just looking at the number is not enough. To fully understand whether you're gaining or losing, you really need to look at the 3 components of interest rate that I really want to talk about first. So the first component of interest rate is inflation rate. Generally, interest rates should be higher than inflation rate. And that's when we talk about interest rate is being adjusted for inflation. What you get when that is done is called the real interest rate. So if your bank offers you 10% interest rate, for instance, but inflation rate is expected to be 25%, your real interest rate is negative, and is negative around negative 15%. So this means that the purchasing power of your savings is really shrinking. So you always want all the time to get a positive real return or real interest rate, just to stay ahead of inflation. Another component of interest rate I want to talk about here is called the risk premium. And this just refers to the extra return that a bank or financial institution offers you based on how risky they think the environment is, or how they think the financial product they are selling to you is. So generally, the higher the risk on the product, the higher the return the institution will want to give you, so that they can compensate you for that risk. The last one I want to talk about here is liquidity premium. What does this mean? It just refers to how easily you can access your money. So the way they say it is that the more liquid the investment, then the lower the interest rate. So generally, savings accounts, they're highly liquid. You can go to the bank, withdraw your money. So generally, you don't get higher return on the savings interest rate you keep in the bank. So generally, if I would advise that if you want to really sacrifice liquidity, if you don't need your money like in the next 6 or 1 year or 2 years, what do? You lock your money for a longer period, and that makes you earn more interest or more return. Anyway, that's all about the understanding the component of interest rate. I want to share the solutions to you. So what we know is that the best savings, in the bank or like typical financial institution will not be high enough to outpace inflation, especially when inflation is too high. And what we have also seen is that generally the interest rate people get on their savings is not catching up with inflation. So in real terms, they are really losing money. So I want to share 6 solutions so that you can think about how to, hedge your savings against inflation. First is you need to think about some of the tech platforms for you to save your money. So think about platforms like PiggyVest. I'm not advertising for them, or Cowrywise or Carbon. These fintech platforms, they offer higher returns, so compared to traditional banks, and you can think about their return in the range of say 7 to 15% per year. In fact, I think PiggyVest also even have something they call the safe lock. So what does that mean? It just means that they're promising you higher return or higher interest so that you can keep your money for a longer period of time with them. So I'm just saying that this is a great way to earn return higher than the general savings interest rate in the bank. Let me explore other options. I want to talk about treasury bill or government bond, as the case may be. So if you have like some loose cash, you can think about treasury bill or government bond. They are very secure because again, government is promising and is backed by the Nigerian government. So whether the government changes hand, it doesn't really change anything. It's pretty much secure. So you have minimal risk. And often we have seen that the interest rate or the return on treasury bill or bond is in the range of 15%, so 20%. So in particular, I think the treasury rate is currently 20%. So it edges inflation a bit. So again, in real term, if you get 20% return and the inflation rate is 32%, you're still losing money, but I think it's better than earning 5% on your savings. The third one I want to talk about is the real estate investments. This is another solid option. I mean, if you look at major cities in Nigeria, like Lagos, Abuja, maybe Port Harcourt a bit, the property prices tend to rise, faster than inflation. So when you invest in land or rental properties, you protect your capital. Sometimes you also earn rental income. So over time, your returns outpace inflation, and your savings interest grow. So I would say, hey, again, if you consider long-term investment, real estate is a way to protect your savings against inflation. The fourth one I want to talk about is commodity investment. And again, you can think about commodities like gold or agricultural product. In fact, some people specifically use their money to buy gold and sell them when they need their money. Again, if you can do this sustainably, you can, keep your money in safe haven and protect your savings from inflation. Um, if you're familiar with the market, again, that's how to diversify your investment and stay ahead of inflation. The fifth one I want to talk about here is called the dollar-based investment. So what dollar-based investment is doing, and I think again, Piggyvest and some of these other fintech platforms, they offer like savings in USD. So you can really protect your savings from depreciation, and you can also hedge them from inflation technically. So if you keep your savings in dollars and maybe dollar prices are rising compared to naira or the country's currency, what happens is that it edges you from inflation, even though you're also getting return, but you're also protecting your savings from general depreciation of naira value. The last one is the stock market investment. Again, this is risky and is meant for people that have the risk appetite for stock. If you consider like growing industry or growing company like tech, the energy, I mean companies that really can pass their prices or increasing costs to customers, what happens is that they generally have like growth in their returns. And if you invest in your money in some of this stock, you can actually get a higher return that can outpace inflation. Hey, to wrap this up, so what I'm just trying to say here is that savings alone won't keep up with inflation, and you are even worse off if your money is not generating any return. I'm just saying you have got different options. Some of these options are not for everyone, but I'm just saying that if you consider some of the six options that I've mentioned, it can again help you to ameliorate the problem of inflation that we have seen. To reiterate, think about some of the fintech platforms that I've mentioned, like Piggyvest or Carrywise or Carbon, some of them, other ones that I haven't mentioned. Think about treasury bill. If you think you don't have a use for your money in the present time, put your money in treasury bill or government bond. They are safe, they have minimal risk. Government is pledging for that kind of the investments with countries' resources, so they are safe. I also mentioned dollar-based investment. If you have some of the dollar-based investment and you have, I mean, you can keep your money for a long time. Those are the options that can also protect you from inflation. I also mentioned, investment in commodities. Some people keep their money in gold or agricultural products. They just know that the prices of these things will continue to rise, and that's also a way to hedge your savings against inflation. And the last one, which I mentioned, which is very risky, not for everyone, is the stock market. So if you think you have higher risk appetite, you can buy stock of companies on the stock exchange, and generally we tend to see that the return on stock outpace inflation. So those are the tips I want to share with you today. If you think this video is helpful in any way, give it a thumbs up. Subscribe to my channel while I continue to churn out content that you find very helpful. I'll see you again in my next video. Take care of yourself. Bye.